You can't talk about beaten down stocks in the stock market without mentioning Fiverr, down 80% from its high. Yep, 80%, around $322 a share. Now it's sitting at only $81 a share. The stock has fell off a cliff. I think it found some support, maybe around the $74 range, but essentially it's been beaten down a lot. And if you're not familiar with Fiverr, I'm saying you're familiar with it. You even maybe used it in the past. It's kind of like a freelance website. If you want to get some work done, like maybe Photoshop, maybe something with music, some transcripts and stuff, you want to do it maybe with somebody overseas, make it a little bit cheaper, you can actually use Fiverr. They have many services, $5, $10, $15 a service. I mean, you just can't find those services anywhere else. And there's Fiverr, there's also Upwork, which I used to own in the past, but I actually sold in the pandemic after it made a huge run. I mean, beyond valuations like Fiverr did at $322 a share. I mean, it's absolutely crazy. Now, in terms of the freelance economy stuff, the freelance is really only getting started. Over 97% of the whole freelance thing is still happening offline, and only 3 to 4% is actually happening online. Now, not all kind of jobs and freelance can really be done online, but I'm sure at least 30% of the whole thing. So as the market grows, which is expected to grow around 15% a year, Fiverr, Upwork, all these companies are gonna grow with the market, if not even surpass the market, especially that it's kind of an untapped market overseas, which is also where Fiverr is trying to expand. And the main reason most people don't want to own Fiverr is because, the argument is that, in 2020, whenever we had the lockdown, the company benefited massively. And after that, all the active buyers, they really left because they don't really need freelance anymore. They could just do it in person. But this is not true. If you look at the active buyers, they actually went up over to 4.1 million active buyers in Q3 of 2021. Q4 is coming up, I believe, in a couple of days, actually. So it would be interesting to see what the numbers look like. But essentially, you could see the massive increase from 3.4 million to 4.1 million. So these customers that really tried to use freelancing in the pandemic, they liked it and they're sticking with it. Maybe it saved them on their budget, or they developed a good relationship with the people they're working on Fiverr. So not only they have more active buyers, but these buyers are spending more on Fiverr, around $234, I believe, per buyer. So it's been increasing every single quarter as Fiverr expand in more kind of services. Now, what has really brought down the stock is actually the revenue growth declining quarter over quarter in Q3. It declined from 75 million to 74 million. And as you could see in the history of the company, every single quarter they pretty much grew revenue except in Q3. And this kind of really shocked Wall Street because they may expect this trend to continue in the future. And this is something you have to pay attention to. Now, Q4 is coming in a couple of days, I believe, maybe on Thursday or Friday, and you have to look for this number. If it's 73 million, I personally predict the stock is gonna fall to the floor because Wall Street is gonna expect that the next quarter is gonna be 72 billion, and then Fiverr is over and all kind of stuff. And you know how Wall Street's overreact. So this is why I predict it's gonna happen. This is an important number you have to watch for. Now, in terms of the business itself, it has pretty high gross margins, around 83%, amazing, but it has a GAAP net loss of around 14 million. Now, the company is free cash flow positive, but it still has a net loss, not a net income. And the main reason for that is because of their spending on sales and marketing. You could see it almost doubled, 9 months, you could say year to date, from 67 million in 2020 to around 119 million in 2021, which made them lose around 45 million. Now, if they did not spend that much on marketing, they actually could have been profitable in terms of net income. But you have to pay attention to something. There's a lot of competition in the space, a lot of competition. It's not just Fiverr and Upwork. A lot of other players are trying to enter the space. Like 2 months ago, LinkedIn is very popular. There's a lot of people on the website. It says LinkedIn lets freelancers promote their services for free on LinkedIn, and it's not the only one. Other players are also trying to get in the space. I'm not saying the space is like over or whatever. It's gonna keep growing forever in terms of a freelance, but a lot of people, they want share of the freelance economy right now. That does not mean Fiverr or Upwork are dead, but that means they may grow a little bit slower in the future, maybe 15 to 20%, in line with the market itself, as more people try to enter the space. Now, if some businesses develop a good relationship with something like Fiverr, for example, and they like the person they're working with, they're gonna keep coming back to Fiverr, which is something good. But you have to pay attention that there's a lot of competition in the space and a lot more to come to try to take that market share from Fiverr or Upwork. One more thing we have to pay attention to is share dilution. Look at the shares outstanding. They went up dramatically in 2019 and then they continued going up steadily, as you could see, into Q3 of 2021. Now the good news is that actually the rate they were going up is only now around 3.5%, so it's decreasing. It's going in on the right track, and I personally believe Fiverr may not really need to raise much money in the future anymore, because after they raise so much money, they have a much better balance sheet, around 562 million in current assets. Current liability is only 180 million, so they have more than enough cash to pay that. They have around 558 million of convertible long-term debt. And Wall Street is expecting much slower revenue growth in the future, and they expect a 43% decline in 2024 in just 1 year. For me, that's unrealistic. Maybe there's a glitch or something, so I didn't take that into consideration. Now I'm going to show you my personal valuation model on Fiverr to make sure that the price is right, because a lot of time the stock goes down and people scream, just go buy the dip because it's down 80%. But the stock may still be overvalued. And let's look at Fiverr to see what kind of price are we paying right now. Now for Fiverr, I use 25% revenue growth for the next 2 years, then 20% for the next 3 years as the company gets more mature. I think you guys can agree with that. For net income margin, this year is expected to be around 2.4%, which is very low. Now I took a massive jump from 2.4% to 20%. Now I personally believe that's unrealistic, but I wanted to get like the best case scenario, and I wanted to be fair for both people that are bullish on Fiverr and people that are bearish on Fiverr. So let's assume Fiverr was able to take their margins from 2% to 20%, and we use a 30p on the stock, which I think is not bad, especially as it's gonna grow slower after 2026, maybe mid-single digits or maybe 10 to 12%. That would give it around a 60% upside for the next 5 years. Now, if you want to be a little bit better and you want to use a 40 PE on the stock, okay, that would be around 6.3 billion market cap, or around 110% upside over the next 5 years. Now, for me, honestly, I think Fiverr is still not a buy. It's still not a buy at all. Now, if you actually look at the enterprise value to revenues, which I used, now it's around 9. 9 is not bad because it was as high as 67, which is massive. But if you actually look at pre-pandemic, it used to trade between 6 to 7. Now we're trading at 9. I personally believe it's going to revert back to 6 and 7. Now, if it does go back to pre-pandemic, before all the excitement, before the huge bid up to over 67 enterprise value to sales, which is pretty high, I think this is when it's really the time to buy the stock. Now, if you want to buy it right now when you're a long-term investor, this is a different story. But based on my valuation model, which I think is pretty fair, 30 or even 40 PE, a 20% net income margin, what better do you really want? It's not going to get a 50% net income margin, or if you want to put 100 PE, you could do that, but I wouldn't personally bet on 100 PE for something like Fiverr or any company for that matter. So this was my honest analysis on Fiverr. Now you could make your own decision. If you enjoyed it, please press like, please consider subscribing. I hope to see you in another video.